Welcome to Financial Statement Analysis 101, where we're going to cover 29 key financial analysis ratios so that you can comprehensively understand how financial analysis works as an investment analyst. In the realm of financial security, dissecting a company's fiscal health is akin to a physician examining a patient. Just as the latter relies on vital signs to gauge well-being, the financial analyst employs four cardinal metrics: profitability, liquidity, solvency, and efficiency. Each offers a unique lens through which to view the company's fiscal vigor, allowing shareholders to make informed decisions. We're going to start with profitability, which is the pulse of success. At its core, profitability measures a company's ability to generate earnings relative to its revenue, assets, and equity. It is, in essence, the pulse of the company's success, indicating the effectiveness with which it converts its resources into net gains. The primary indicators here include net profit margin, return on assets, and return on equity. A robust profitability metric signals a company's adeptness at enhancing shareholder value and sustaining growth in the competitive market landscape. Next, we'll look at liquidity, which is the fluidity of operations. Liquidity, the financial equivalent of a company's circulatory system, assesses its capacity to meet short-term obligations without raising capital. This metric is crucial for ensuring the uninterrupted flow of operations akin to the blood flow of the body. Key ratios such as the current ratio and quick ratio provide insights into the company's ability to cover its short-term liabilities with its short-term assets, highlighting its operational fluidity and resilience in facing financial exigencies. Then we'll take a look at solvency, which is the backbone of stability. Solvency reflects a company's capability to meet its long-term debts and financial obligations, essentially representing its financial backbone. It is an indicator of a firm's long-term health and stability, ensuring it can sustain operations, grow, and weather economic downturns. Ratios like the debt-to-equity ratio and interest coverage ratio offer a glimpse into the company's debt management and its ability to service its debt, underpinning its financial integrity and endurance. Finally, we'll look at efficiency, which is the measure of optimal resource utilization. Efficiency is the metric that gauges how effectively a company utilizes its assets and liabilities to generate revenue. It is a reflection of the company's operational prowess, revealing how adeptly it converts its resources into income. Efficiency ratios such as asset turnover ratio and inventory turnover delve into the nitty-gritty of operational performance, spotlighting the prowess in managing assets to maximize output and profitability. In the intricate dance of financial analysis, these four metrics, profitability, liquidity, solvency, and efficiency, serve as the fundamental steps. Together, they sketch a comprehensive picture of a company's financial health, guiding investors, creditors, and management in navigating the complex business terrain. By mastering these metrics, one can discern the subtle nuances of financial statements, unlocking the stories they tell about past performances, present standings, and future prospects. Now we're going to examine each of these four areas of financial analysis. We're going to identify the key financial ratios which a financial analyst needs to understand. These will be defined with the formula, an example provided, and an explanation of their pros and cons. At the end of this video, you will understand 8 profitability ratios, 7 liquidity ratios, 8 solvency ratios, and 6 efficiency ratios. Let's start then with profitability ratios. The first ratio we're going to take a look at is the gross profit margin. The gross profit margin is defined as the measure of the proportion of revenue that exceeds the costs of goods sold. It is the vanguard revealing the efficiency with which a company produces its goods or services. On the plus side, it's a clear indicator of production efficiency and pricing strategy effectiveness. A high margin suggests a strong position to cover operating expenses and yield profits. On the negative side, this ratio overlooks broader financial elements such as administrative expenses, potentially painting an incomplete picture of the overall profitability. So the formula is the gross profit margin equals gross profit divided by revenue times 100. And if we take an example, if a company's revenue is £500,000 and the costs of goods sold is £300,000, the gross profit is 500,000 minus 300,000, which equals 200,000. So the gross profit margin would be 200,000 divided by 500,000 times 100, which is 40%. Next, we're going to take a look at the operating profit margin, which is the operational insight. The definition of this is the ratio reveals what portion of the revenue remains after deducting operating expenses. It is a lens focusing on the core business operations, excluding financial and tax impacts. The pros are that it offers a pure view of operational efficiency, making it invaluable for comparing companies within the same industry. Negatively, it can be skewed by non-operational income or expenses, leading to possible misinterpretations of operational performance. So the formula is the operating profit margin equals operating profit divided by revenue times 100. So looking at an example, with a revenue of £500,000 and operating expenses of £150,000, the operating profit is 500,000 minus 150,000, which is 350,000. The operating profit margin would therefore be 350,000 divided by 500,000 times 100, which is 70%. Next, we consider the net profit margin, the bottom line beacon. The definition is that the net profit margin is the ultimate measure, showing the percentage of revenue that becomes profit after all expenses. On the plus side, it encapsulates the company's overall financial health, incorporating all aspects of the business operations. On the negative side, it can be influenced by one-off items or non-operational factors, thus requiring careful analysis to discern underlying trends. So the formula for the net profit margin is net profit divided by revenue times 100. If the revenue is 500,000 and total expenses, including costs of goods sold, operating expenses, interest and taxes, are 400,000, the net profit is 500,000 minus 400,000, which equals 100,000. So the net profit margin would be 100,000 divided by 500,000 times 100, which is 20%. The fourth of these ratios is the return on assets, or ROA, which is the asset utilization gauge. The ROA indicates how effectively a company employs its assets to generate profit, operating a measure of asset efficiency. The pros are it's a broad indicator of managerial efficiency and how well assets are leveraged to produce earnings. On the negative side, high leverage can distort ROA, and it may vary significantly across different industries. The formula is return on assets equals net income divided by total assets times 100. So for a company with net income of 50,000 and total assets of 250,000, the ROA would be 50,000 divided by 250,000 times 100, which equals 20%. Now we'll take a look at the return on equity, or ROE. This is the shareholder value measure. ROE assesses a company's ability to generate profits from shareholders' equity, serving as a barometer for investor returns. On the plus side, it's crucial for evaluating the financial returns provided to equity investors, reflecting the company's capital efficiency. On the negative side, it can be inflated by high debt levels, potentially misleading about true equity performance. So the return on equity equals net income divided by shareholders' equity times 100. So if net income is 50,000 and shareholders' equity is 200,000, the ROE would be 50,000 divided by 200,000 times 100, which is 25%. Next is the return on capital employed, or ROCE. This is the investment efficiency metric. ROCE measures the returns that a company generates from its total capital employed, offering insights into the efficient use of capital. It provides a more comprehensive view of profitability by considering both equity and debt financing. However, the calculation can be affected by changes in capital structure and so requires careful interpretation. The formula is that the ROCE equals earnings before interest and tax, which is EBIT, divided by total assets minus current liabilities times 100. So with EBIT of 60,000, total assets of 250,000, and current liabilities of 50,000, the ROCE would be 60,000 divided by 250,000 minus 50,000 times 100, which equals 30%. Now we'll take a look at the return on investment, or the ROI. This is the performance benchmark. ROI calculates the return on a specific investment relative to its cost, serving as a universal benchmark for assessing financial performance. It's versatile and widely applicable, offering a straightforward measure of investment efficiency. However, it doesn't account for the time value of money and can be skewed by varying accounting practices, so you need to be aware of that. The formula is that the ROI equals net profit from investment divided by the cost of investment times 100. So if the net profit from an investment is 10,000 and the cost of the investment was 40,000, the ROI would be 10,000 over 40,000 times 100, which equals 25%. Finally, we'll look at earnings per share, EPS. This is the profitability per share indicator. EPS indicates the portion of a company's profit allocated to each outstanding share of common stock, directly linking profitability to shareholders. It is a key metric for investors, reflecting the direct impact of profitability on shareholder value. However, EPS can be influenced by share buybacks and changes in capital structure, potentially distorting the true profitability picture. The formula is earnings per share equals net income divided by the number of outstanding shares. For a company with a net income of 100,000 and 50,000 outstanding shares, the EPS, or earnings per share, would be 100,000 divided by 50,000, which equals £2 per share. So to summarise, in the complex tapestry of financial analysis, profitability ratios serve as critical threads, each offering unique insights into a company's fiscal prowess. While each ratio has its strengths, providing valuable perspectives on different facets of profitability, they also come with inherent limitations. A holistic approach, considering multiple ratios in conjunction, offers the clearest view, guiding stakeholders through the financial landscape with precision and insight. Next, we're going to take a look at liquidity ratios. Liquidity ratios are the way to navigate short-term financial health. They are the financial world's litmus test and help you to assess a company's capability to meet its short-term obligations. The metrics include the current ratio through to the net working capital ratio, and they provide a snapshot of financial resilience. Let's look into each ratio then, understanding their significance and the nuances that they bring to light. The first of these is the current ratio, which is the financial equilibrium gauge. The current ratio measures a company's ability to cover its short-term liabilities with its short-term assets. It is the equilibrium gauge, offering a basic yet powerful insight into liquidity. On the plus side, it provides a broad overview of financial health, indicating if a company has enough resources to cover its immediate liabilities. On the negative side, it doesn't differentiate between liquid assets and those harder to convert to cash, potentially overstating liquidity. The formula is the current ratio equals current assets divided by current liabilities. So if a company has £200,000 in current assets and £100,000 in current liabilities, the current ratio is 200,000 over 100,000, which is 2.0. This indicates the company has twice as many current assets as liabilities. Next, we look at the quick ratio, which is the acid test of liquidity. By excluding inventory, the quick ratio assesses a company's capacity to meet short-term obligations with its most liquid assets. It is the acid test, offering a stringent liquidity measure. It provides a more conservative view by focusing on assets that can be quickly converted to cash. However, it may underestimate liquidity by excluding inventory, which can be significant in certain industries. The formula is the quick ratio equals current assets minus inventory over current liabilities. So, as an example, with £200,000 in current assets, £50,000 in inventory, and £100,000 in current liabilities, the quick ratio is £200,000 minus £50,000 divided by £100,000, which is 1.5. This suggests the company can cover its short-term liabilities 1.5 times over without relying on inventory sales. Next, we look at the Days Sales Outstanding, or DSO. This is the receivables timeline. The DSO indicates the average number of days it takes for a company to collect payments after a sale. It is the receivables timeline, highlighting the efficiency of credit policies and collections. On the plus side, it offers insights into cash flow management and the effectiveness of credit and collection policies. However, a high DSO can indicate inefficiency, but may also reflect industry norms or strategic credit terms. So the formula for the DSO is the average accounts receivable divided by total credit sales times the number of days. So, if an average accounts receivable is £25,000, total credit sales for the year are £300,000, and the number of days is 365, the DSO is 25,000 divided by 300,000 times 365. In a leap year, this would be 366. This sum comes to 30.42 days. This means it takes, on average, around 30 days to collect payment after a sale. The Days Inventory Outstanding, or DIO, is the inventory efficiency metric. The DIO measures the average time a company holds inventory before selling it. It is a metric of inventory efficiency, shedding light on production and sales processes. On the plus side, it helps in assessing inventory management and the alignment of production with sales demand. But a lower DIO isn't always positive because it could indicate understocking and potential lost sales. The formula for the DIO is average inventory divided by cost of goods sold times number of days. So as an example, with £50,000 in average inventory and £600,000 in costs of goods sold for the year, the DIO is 50,000 over 600,000 times 365, which is 30.42 days, indicating that inventory is turned into sales every 30 days. The Days Payables Outstanding, or DPO, is the payment strategy indicator. The DPO calculates the average duration a company takes to pay its suppliers. It is the payment strategy indicator, reflecting how a company manages its cash outflows. It provides insights into a company's payment policies and its ability to utilize credit lines efficiently. On the negative side, extending DPO to improve liquidity might strain supplier relationships and affect terms of trade. The DPO is calculated by taking the average accounts payable, dividing them by the costs of goods sold times the number of days. So, if the average accounts payable is £40,000 and the cost of goods sold is £600,000, DPO is 40,000 divided by 600,000 times 365, which is 24.33 days. This shows the company takes around 24 days to pay its suppliers. Next, we look at the cash conversion cycle. This is the complete liquidity cycle. The cash conversion cycle, or CCC, combines the DSO, the DIO, and the DPO to show how long it takes for a company to convert resource inputs into cash flows. It is the complete liquidity cycle, encapsulating the journey from inventory purchase to cash collection. On the plus side, it offers a comprehensive view of a company's operational efficiency and liquidity management. However, its complexity can make it harder to interpret, and it may be less relevant in service-oriented industries. The formula then is CCC equals DIO plus DSO minus DPO. So using the DIO of 30.42 days, the DSO of 30.42 days, and the DPO of 24.33, the CCC is 30.42 plus 30.42 minus 24.33, which is 36.51 days. This represents the total time from acquiring inventory to receiving cash from sales. Next, we look at the net working capital ratio, which is the operational liquidity barometer. This ratio compares net working capital, current assets minus current liabilities, to total assets, serving as an operational liquidity barometer. It gives a quick snapshot of operational liquidity and the ability to finance day-to-day operations. However, it can be influenced by non-cash items, potentially distorting the liquidity perspective. So the formula is net working capital ratio equals current assets minus current liabilities divided by total assets. So as an example, with £200,000 in current assets, £100,000 in current liabilities, and £500,000 in total assets, the ratio is 200,000 minus 100,000 divided by 500,000, or 0.2 or 20%. This indicates that net working capital is 20% of total assets. Liquidity ratios serve as the financial sentinels, guarding against short-term insolvency. Each ratio, with its unique focus, provides invaluable insights into a company's liquidity position. However, they are not without their limitations and should be viewed within the broader context of the company's industry, strategy, and market conditions. A nuanced understanding of these ratios can empower stakeholders to make informed decisions, ensuring financial stability and operational agility. Next, we're going to move on to solvency ratios. Solvency ratios are all about assessing the long-term financial stability. Solvency ratios serve as the bedrock of assessing a company's long-term financial viability and its capacity to meet long-term obligations. These metrics, from debt to assets to funded debt to EBITDA, provide a window into the firm's financial structure and debt management. Let's explore the essence, strengths, and limitations of each solvency ratio. We'll start with the debt to assets ratio, which is the leverage landscape. The debt to assets ratio measures the proportion of a company's assets financed by debt, offering a panorama of its leverage. It provides a clear picture of the company's reliance on debt financing and overall financial risk. It doesn't distinguish, however, between short and long-term debt, which can blur the understanding of immediate financial pressures. The formula for debt to assets ratio is total debt divided by total assets. So if a company has £400,000 in total debt and £800,000 in total assets, the debt to assets ratio is 400,000 divided by 800,000, or 0.5, which indicates 50% of the company's assets are financed through debt. Next, we take a look at the debt to equity ratio, which is the capital structure scale. This ratio compares the total debt to shareholders' equity, elucidating the capital structure and equity holders' stake relative to creditors. It offers insights into the company's financing strategy and risk profile from an equity perspective. However, high debt levels may not always signify risk if the debt is being used efficiently to generate returns. The debt to equity ratio formula is total debt divided by total shareholders' equity. With £400,000 in total debt and £600,000 in shareholders' equity, the debt to equity ratio is 400,000 divided by 600,000, or 0.67, showing that the company uses 67 pence in debt for every £1 of equity. Next, we look at the debt service coverage ratio, or DSCR, which is the repayment capacity counter. DSCR assesses a company's ability to service its debt with its operating income, acting as a counter of repayment capacity. It's crucial for lenders and investors to evaluate the company's ability to cover loan payments. However, it can be influenced by non-cash expenses and one-off items, potentially misrepresenting cash flow availability. The DSCR, or debt service coverage ratio, formula is calculated as the net operating income divided by total debt service. So, for example, if net operating income is £200,000 and total debt service, which is principal and interest payments for the year, is £150,000, then the DSCR is 200,000 over 150,000, which is 1.33, which indicates the income covers the debt service 1.33 times. Now we'll have a look at the return on capital employed, ROCE, which is the efficiency evaluator. And we have looked at this above in the profitability section, but it also applies to this area as well. So the ROCE measures the returns a company generates from its capital employed, highlighting the efficiency of capital utilization. It provides a comprehensive view of how well the company uses its capital to generate profits. But comparisons may be misleading across industries with different capital intensities. The formula for the ROCE is earnings before interest and tax, EBIT, divided by total assets minus current liabilities. For example, for EBIT of £100,000, total assets of £800,000, and current liabilities of £200,000, ROCE is 100,000 divided by 800,000 minus 200,000, or 1.67 or 16.7%, showing the efficiency of capital use in generating profits. Next is the fixed charge coverage ratio, the obligation overcomer. This ratio measures a company's ability to cover fixed charges, like interest and leases, with its earnings, reflecting its capacity to overcome financial obligations. It is a detailed measure of financial flexibility and the ability to sustain operational hiccups. However, it may not fully account for variable costs that can significantly impact financial stability. The fixed charge coverage ratio formula is EBIT plus fixed charges before tax divided by fixed charges before tax plus interest. So with EBIT of 100,000, fixed charges of 50,000 and interest of 30,000, the ratio is 100,000 plus 50,000 divided by 50,000 plus 30,000, or 2.14, indicating that earnings cover fixed charges 2.14 times. Next, we take a look at the interest coverage ratio, the interest shield. The interest coverage ratio shows how easily a company can pay interest expenses on outstanding debt, serving as a shield against insolvency. It is a direct indicator of financial health concerning interest obligations and the company's cushion against financial distress. It focuses solely on interest, ignoring the principal repayments and other fixed financial commitments, so you need to be aware of that. The formula is the interest coverage ratio equals EBIT divided by interest expenses. So if EBIT is £120,000 and interest expenses are £40,000, the interest coverage ratio is 120 divided by 40,000 equals 3, showing the company can afford its interest payments 3 times over with its earnings. Next, we take a look at the tangible net worth ratio, the real value revealer. This ratio compares the company's tangible net worth, which excludes intangible assets, to its total liabilities, revealing the real value backing the company's obligations. It provides a conservative estimate of a company's solvency by focusing on tangible assets. However, it may undervalue companies with significant intangible assets that contribute to their profitability. The formula for the tangible net worth ratio is tangible net worth divided by total liabilities. With tangible net worth, total equity minus intangible assets of 300,000 and total liabilities of 500,000, the ratio is 300 over 500, which is 0.6, indicating that tangible assets cover 60% of liabilities. Next, we look at the funded debt to EBITDA ratio, the long-term debt decoder. This ratio compares long-term debt to EBITDA, decoding the company's ability to pay off long-term liabilities with its core earnings. On the plus side, it offers a clear view of the company's long-term debt management and repayment capacity. However, EBITDA does not account for capital expenditures or changes in working capital, which can affect cash flow. The formula for the funded debt to EBITDA ratio is long-term debt divided by EBITDA. If long-term debt is 250,000 and EBITDA is 125,000, the ratio is 250 over 125, or 2.0, showing the company has twice its EBITDA in long-term debt. Solvency ratios are indispensable for peering into the financial foundations of a company, offering nuanced insights into its long-term viability. Each ratio, with its distinct focus, sheds light on different aspects of solvency, from debt management to the efficiency of capital use. However, it's crucial to consider these ratios in the context of industry norms, economic conditions, and the company's strategic direction. A holistic approach, combining multiple solvency metrics, provides the most accurate picture of financial stability and risk. Finally, we're going to take a look at efficiency ratios. Efficiency ratios are all about streamlining operational performance. Efficiency ratios are the metrics that dissect a company's operational effectiveness, shine a light on how adeptly it manages its resources to generate sales. These ratios, from accounts receivable turnover to working capital turnover, offer insights into the company's operational prowess. Let's delve into the essence and implications of each efficiency metric. We'll start with the accounts receivable turnover, the receivables efficiency metric. This ratio measures how often a company collects its average accounts receivable, indicating the efficiency of credit policies and customer payments. It provides insights into cash flow management and the effectiveness of a company's credit and collection strategies. However, a high turnover could also indicate overly strict credit policies, potentially limiting sales. The formula for accounts receivable turnover is net credit sales over average accounts receivable. So if a company has net credit sales of 500,000 and average accounts receivable of 50,000, the accounts receivable turnover is 500,000 over 50,000, which is 10. This means the company collects its receivables 10 times a year. The inventory turnover is the stock efficiency indicator. The inventory turnover assesses how frequently a company sells and replaces its stock, reflecting the efficiency of inventory management and sales performance. On the positive side, it helps in identifying potential inventory management issues and aligning stock levels with sales demand. However, too high a turnover might suggest stock shortages, while too low could indicate excess inventory or weak sales. So inventory turnover is cost of goods sold divided by average inventory. With a cost of goods sold of £600,000 and average inventory of 100, the inventory turnover is 600,000 divided by 100,000, or 6. This indicates that the company sells and replaces its inventory 6 times a year. Accounts payable turnover is the creditor payment metric. This ratio gauges the rate at which a company pays off its suppliers, offering insights into the management of payables and cash flow. It provides a view of how a company manages its cash outflows and relationships with suppliers. A higher turnover, however, may indicate quick payments, potentially foregoing the benefits of longer credit terms. The accounts payable turnover is defined as total purchases divided by average accounts payable. If total purchases are 400,000 and average accounts payable is 80,000, the accounts payable turnover is 400 divided by 80, which is 5. And this suggests that the company pays off its suppliers 5 times a year. The asset turnover is the resource utilization gauge. The asset turnover measures how efficiently a company uses its assets to generate sales, highlighting overall operational efficiency. It's a broad indicator of how well a company is leveraging its assets to produce revenue. However, the ratio can be affected by industry specifics and doesn't consider asset quality or condition. Asset turnover is defined as net sales divided by average total assets. With net sales of 1 million and average total assets of 500,000, the asset turnover is 1 million divided by 500,000, or 2. This ratio shows the company generates £2 in sales for every £1 of assets. The fixed asset turnover is the capital investment efficiency ratio. This ratio compares sales to fixed assets, indicating how effectively a company uses its long-term investments to generate sales. It's a key for assessing productivity of capital investments and long-term assets in generating sales. However, it may not accurately reflect companies with significant intangible assets or those in service industries. So the fixed asset turnover is net sales divided by average fixed assets. If net sales are 1 million and the average fixed assets are 250,000, the fixed asset turnover is 1 million divided by 250,000, or 4. This indicates the efficiency with which the company uses its fixed assets to generate sales, with £4 in sales for every £1 of fixed assets. Next, we look at the working capital turnover, the operational efficiency measure. Working capital turnover shows how effectively a company uses its working capital to support sales, reflecting the efficiency of using short-term assets and liabilities. It offers insights into how well a company is managing its short-term resources to generate sales. However, a high ratio might indicate over-reliance on short-term assets or underinvestment in necessary resources. Working capital turnover is defined as net sales divided by average working capital. With net sales of 1 million and average working capital, which is current assets minus current liabilities, of 150,000, the working capital turnover is 1 million divided by 150,000, or 6.67. This suggests the company generates £6.67 in sales for every £1 of working capital. So efficiency ratios are the linchpins in understanding a company's operational effectiveness, each providing a unique perspective on resource management. However, of course, they come with their own sets of nuances. High turnover rates in receivables and inventory might indicate operational excellence, but could also suggest underutilized resources or overly conservative credit policies. Similarly, low turnover rates might point to inefficiencies or overinvestment. Contextual analysis, considering industry norms and operational strategies, is crucial in interpreting these ratios accurately. Employing, as ever, a holistic approach that balances operational efficiency with strategic flexibility can lead to sustainable growth and profitability. So let's summarize what we've covered in this video. I want to go through a comprehensive summary of our financial ratio analysis. Financial ratio analysis is an indispensable tool for assessing a company's financial health, encompassing four critical areas: profitability, liquidity, solvency, and efficiency. Each category serves as a distinct purpose in evaluating different aspects of a company's financial performance and operational effectiveness. Let's provide a concise overview of these essential financial metrics. Profitability ratios measure earning capacity. Profitability ratios are fundamental in evaluating a company's ability to generate earnings relative to its sales, assets, and equity. Key ratios include gross profit margin, net profit margin, and return on equity, among others. These ratios are crucial for understanding how effectively a company converts its operations and investments into profits. The key insight here is that high profitability indicates strong financial health, but it's important to compare these ratios against industry averages for a balanced assessment. The liquidity ratios assess short-term financial health. Liquidity ratios such as the current ratio and quick ratio measure a company's capacity to meet its short-term obligations. These ratios are vital for evaluating the company's ability to pay off its immediate liabilities without necessitating additional capital. The key insight is that adequate liquidity ensures operational continuity, yet overly high liquidity might suggest the inefficient use of resources. Solvency ratios evaluate long-term viability. Solvency ratios focus on a company's ability to sustain operations in the long term by meeting its debt obligations. The debt-to-equity ratio and interest coverage ratio are among the key metrics used to assess the balance between debt financing and equity, and the company's capability to cover interest payments. The key insight: a prudent mix of debt and equity can fuel growth, but excessive debt increases financial risk and can impact long-term sustainability. Finally, the efficiency ratios. These are all about optimizing operational performance. Efficiency ratios, including inventory turnover, asset turnover, and accounts receivable turnover, provide insights into how effectively a company utilizes its assets to generate revenue. These ratios are indicative of the company's operational efficiency and asset management prowess. The key insight: a high efficiency ratios suggest effective management, but they need to be aligned with the company's strategic goals to drive meaningful growth. So to summarize, financial ratio analysis offers a comprehensive framework for the understanding of a company's financial state and operational efficiency. By integrating insights from profitability, liquidity, solvency, and efficiency ratios, stakeholders can gain a holistic view of the company's performance and make informed decisions. It's essential to consider these ratios in conjunction with industry benchmarks and economic conditions for a well-rounded analysis. So that concludes our video on financial statement analysis, where I've covered 29 key financial analysis ratios. I hope you found this video helpful, interesting, but above all, educational to help you become a better financial analyst.